Hey guys, welcome back to a brand new video. I'm RexFinance, and boy, do we have an important one today. If you're an investor, which, chances are you clicked on this video so you invest your money, you would know that the month of August has been brutal for the stock market. And today, the Nasdaq's down another 2.12%, and the markets aren't even closed yet. The market's closed in 5 minutes, so this could get even worse. Who knows? But this is particularly surprising because just yesterday, we had the most anticipated earnings report perhaps ever in the history of the stock market when NVDA reported their earnings. And they smashed. I mean, their earnings were great. Their guidance was great. Their stock was up 6% after hours. And then today, the Nasdaq's down 2%. You also have a company like Disney that is back to 2014 levels. So if you put money into Disney stock at the end of 2014, you would be flat. You would not have made a single dollar, which is crazy to think about. Disney, by the way, today is down 3.68%. You also have stock like Enphase feeling pain back to 2020 levels, and Enphase today is down more than 6%. Tesla, also back to 2020 levels, is down more than 2.75%. Now, back in October of 2022, on October 6th of 2022, I posted this video called Stocks Just Bottomed and Nobody Noticed. Safe to say nobody noticed this video because it has less than 1,700 views. But if you go back and rewatch this video, I was correct about basically everything I said. And yeah, stocks bottomed in early October like I mentioned I thought they would. Now, fast forward to August of this year. On August 1st, I posted a video, Stocks Are All About to Dip. Here's why, and this is also played out to a T. We discussed how August has been a terrible month for the stock market, right? August 1st was basically the top of the market. So again, I was correct. Now, I don't have a crystal ball. Maybe I've just gotten lucky. In fact, I think this has more to do with luck than skill, but a lot of people are wondering my opinion now. Now that stocks have dipped in August, what do I see happening for the rest of this year and in 2024? So today is going to be a very important video, me updating you on my thesis on the stock market. And tomorrow is the most important day of the year for the stock market. Jerome Powell is set to deliver a speech at the Jackson Hole meeting. Remember Jackson Hole last year? Yeah, it tanked stocks last year because it came out so hawkish, saying that the economy would feel a ton of pain as a result of them raising interest rates to combat inflation. So going into this meeting tomorrow, by the way, he speaks tomorrow morning around 9 a.m. Central Time. The markets are fearful that he's going to remain very hawkish despite inflation falling significantly. Just to evidence this, we can look at the 10-year Treasury yield, which is up to 4.235%. That is above last year's highs, and during the month of August, again, basically since the middle of May, this 10-year Treasury yield has been rising. This is bad for the stock market because it creates valuation crunch. I mean, you can get 4.239% on your money in a 10-year Treasury, or well over 5% in a short-term Treasury. Why would you not put some of your cash in these Treasury bills and get risk-free return of 4 to 5 to almost 6%, right? It just makes sense. So the higher that Treasury yields go, typically the lower valuation than the stock market go, which results in the stock market selling off. But beyond this, more economically, if Treasury yields rise, it's signaling that the markets expect interest rates to go higher, and specifically because the 10-year Treasury is skyrocketing, the markets are saying we expect interest rates to remain high for a very, very long time. Now, we're actually seeing a disinversion of the yield curve, the 10-year minus the 2-year Treasury yield, and this isn't the direction we want it to go. Yes, we want it to disinvert. That'd be a good thing to see, but it's disinverting the wrong way. With the 10-year Treasury yield catching up to the 2-year Treasury yield, we would want to see the 2-year Treasury yield fall and catch up to the 10-year Treasury yield, not the 10-year Treasury yield rise and catch up to the 2-year Treasury yield. That's not a good thing that we're seeing currently. And if the markets are correct that rates are going to go higher and stay higher, it raises the risks of defaults in the economy, particularly with commercial real estate holders, which I've talked about in the past. Now, it's not the yield curve inversion that predicts a recession. It's actually credit crunches that predict recessions. If the 10-year Treasury yield and all these Treasury yields continue to rise and interest rates rise, we're going to see more defaults, which increases the risks that we could see a credit crunch. Now, the reason we didn't see a credit crunch in March when Silicon Valley Bank failed this year is because the Fed acted so quickly. However, if we keep having scenario after scenario of more banks going under, the Fed's power is going to be limited in trying to limit this credit crunch. So far, they've been successful, but who's to say they'll be successful in the future if they try and combat banks defaulting? Now, contrary to popular belief, the reason the markets think rates are going to go higher is not necessarily because of inflation. For the most part, inflation has been defeated. Like if we look at the CPI excluding shelter, which inevitably is going to fall, there's just certain lag effects with shelter and how quickly it hits the CPI data. Excluding shelter, all other items in the economy, inflation year over year headline, CPI, is only 2%. That's the Fed's target, is 2%. Core CPI excluding shelter is at 2.5%, very, very close to the Fed's goal. Now, because we know shelter is going to inevitably fall, that's going to put even more negative pressure on the headline and core CPI data points, which just gives us credence to the fact that inflation is no longer a battle. But what is a battle is the fact that CPI inflation might stay slightly above 2% for quite some time. The reason this is a problem is because in the past, Jerome Powell has been very, very hawkish, saying that they will not settle at all until inflation is at 2%, 2.0% or lower. He's not going to settle for 2.2%, 2.3%, 2.5%. They're going to settle once they get to 2%. That's been his words in the past. So the problem here is not us potentially seeing a resurgence of inflation or inflation remaining very, very sticky at the 3 to 4% level. The risk is that inflation could stay sticky at the 2.1 to 2.5% level, and according to the way Powell has talked in the past, that wouldn't be good enough. And the only way to push the inflation rate down to 2% or lower would be more rate hikes. But tomorrow at the Jackson Hole meeting, I don't think Powell has a choice. He has to calm the bond markets down because of the reasons I've already laid out. If yields continue to rise and rates go up, it leads to the risk that we could see more defaults and the risk that we could see some credit crunches happen, which could lead to a recession. The Fed does not want to have a recession. They have a track record that they want to maintain, just like you and me at our jobs. Now, recently on Twitter, or they call it X now, and YouTube and all these other social media platforms, and even on CNBC, there's been a rise in the popularity of LEI, leading economic indicators. Just to give you some background, the leading economic indicators have been correct in predicting the previous 8 recessions, with an average lead time of around 12 months. However, this time, the leading economic indicators topped in December of 2021 and have been downtrending ever since then. These indicators have fallen for 16 straight months, and the LEI as a whole is down more than 10% since December of 2021. And because the LEI usually gives us a lead time of around 12 months, it means that the recession is long overdue when we look at the leading economic indicators. And people are looking at this saying because it's been accurate at predicting the last 8 recessions, it's going to be accurate again and we're going to see a recession. And if you've been following my channel for a while, which by the way, we're one of the fastest growing stock market YouTube channels currently, I'd like to maintain that. So help the trend, hit the subscribe button down below. But if you've been following my channel at all, you would know that towards the beginning of 2023, it might have even been the end of 2022, I mentioned that I did not think we were going to see a recession in 2023, but I mentioned that I thought 2024 could be a difficult year for stocks because I believed at that point that we would see the recession hit in 2024. So the question is, according to the LEI, the leading economic indicators, we're long overdue for a recession. And my previous thesis was that we would see a recession in 2024. Do I still think that's the case? My quick answer is no. I believe that this rolling recession we've seen is going to continue, and we will never see an economy-wide recession. You see, the LEI has 10 components to it. Half of those components are directly attributable to the goods economy, and then we have 3 other components that are related to the financial markets. 2 of those 3 track the labor market and consumer expectations. So the LEI heavily overweights the goods economy and kind of ignores the services economy, which is perhaps why we're seeing negative leading economic indicators, but the recession is nowhere to be found because the goods economy typically is more cyclical, and it has been in a recession. The goods economy has been in a recession. And the services economy has been booming. We can just look at Foot Locker stock, who reported earnings, and their stock went down the next day by 35%. Absolutely crazy. The only retailer doing well right now is Walmart. That should tell you a lot about the state of the goods economy. But you see on this chart how the real GDP for goods and the leading economic indicators have correlated relatively closely with each other ever since 1959, which is as far back as this data goes. It's relatively correlated, if not highly correlated. If we move to look at the real GDP for services, the data for the leading economic indicators is kind of all over the place, and then the data for real GDP in the services economy is kind of just not real, doesn't really move. So we see a high correlation between leading economic indicators and real GDP goods, and no correlation at all, maybe a slight correlation between leading economic indicators and the GDP services, but if there is correlation, it's not much. So this, again, gives credence to the fact that the leading economic indicators might be misleading to investors if you're looking at this as to why we're going to see a recession. And then to really hammer this point home, we can look back to 1964 or 65, which is when the services sector of our economy began to make up a larger portion than the goods sector of our economy. Ever since then, the services sector of the economy has made up a larger and larger and larger percentage of our overall GDP, while the share of the goods sector in our overall GDP has fallen and fallen and fallen and fallen. As of Q2, the services sector made up over 60% of our country's GDP, which is very, very significant. So because of this, we can't look at leading economic indicators and say that we're going to see a recession because it's predicted the last 8 recessions. The leading economic indicators heavily overweight the goods sector of the economy, and as a result of this, I no longer think we will see an economy-wide recession. So in my opinion, and I'm overdue to be wrong, I got October 2022 right and I got the beginning of August right. I believe that this week the markets have found their bottom. I believe that by the end of this year, the NASDAQ and the S&P 500 will set new all-time highs. I believe that this has just been a small correction in the overall stock market. Now, if Jerome Powell comes out tomorrow as a hawk, very, very hawkish, at the Jackson Hole meeting, which I think is unlikely, I would rescind that opinion and say that I still do think a 2024 recession is on the table and that 2024 could be a rough year for the stock market, as well as the rest of 2023. But because I don't think that's going to happen, I do believe that we have found our bottom this week and that we're going to get right back to this bull market, and by the end of this year, we're going to set new all-time highs in the stock market. With that, again, if you guys are new here or returning and not yet subscribed, please subscribe down below. It makes my day to see all the new faces. Have a great rest of your day. Stay blessed. Keep 10 toes to the ground and your chin up. Peace out.